Welcome back to the Financial Independence Network Channel's Friday series. The joys of adulting. You know what they say, save your pennies and the pounds will look after themselves. But where to stash your hard-earned cash for the best return? Two popular options are high-yield savings accounts and certificates of deposit, or as we'll call them, CDs. In a high-interest environment like today, understanding the differences between these two options can help consumers make informed decisions about where to put their money. Let's take a look at the differences between the two, in a way that won't put you to sleep. Make sure to hit the subscribe button on the top right to support this channel. In a high-interest environment like today, both high-yield savings accounts and CDs can be good options for earning interest on savings. So, what's the difference between the two? First up, we have high-yield savings accounts. These babies offer a higher interest rate than traditional savings accounts. That means more money in your pocket. Woo-hoo! These accounts are offered by banks and credit unions. Plus, they're FDIC or NCUA insured, which means your cash is protected, up to a certain limit. But let's not think about that. Most high-yield savings accounts allow for unlimited withdrawals and transfers, so you can take your money anytime you want, which is great for those of us who like to impulse buy. They offer more flexibility and are great for emergency savings or short-term goals. Additionally, high-yield savings accounts typically have variable interest rates, which means that the interest rate may fluctuate over time. This can be both a positive or negative depending on market conditions. However, some accounts have restrictions on the number of transactions you can make, so keep an eye out for that. On the other hand, we have CDs. These little guys typically offer higher interest rates than a high-yield savings accounts and require you to deposit your money for a fixed period of time, ranging from a few months to several years. If the term is short, the interest rate may not be much higher than a high-yield savings account, but longer terms can offer significantly higher rates. CDs are also FDIC or NCUA insured, so deposits are protected up to certain limits. But they also come with restrictions. You can't touch your cash until the term is up without incurring a penalty. Ouch! If the term is short, the penalty may be a small amount, but longer terms can have higher penalties. CDs are ideal for long-term savings goals, like a down payment on a house or a college education for your future child prodigy. By locking in a high interest rate for a fixed period of time, consumers can ensure that their savings will grow steadily. So, if you're the kind of person who likes to dip into your savings for a weekend getaway or a new pair of shoes, this might not be the best option for you. Ultimately, the decision comes down to what you want to do with your money. Are you saving up for something specific, or just want to make a bit of extra cash on the side? Do you want to be able to access your money at any time, or are you willing to wait it out for a bigger return? Whatever you decide, just remember that saving money is important, but it doesn't have to be boring. So go ahead and treat yourself to that fancy latte. Just make sure to put a little aside for the future too. That concludes our video. If you enjoyed this content, please comment, like, and share. Also, make sure to subscribe and hit the notification bell so you don't miss our next video. Thanks for watching.